Religare Invesco Mutual Fund joins us. Vetri, good morning and fantastic to have you back. Things are falling and things are falling very hard. Why have markets reversed so sharply?
Hard to say, Nikunj, but we have the luxury of not focusing on markets on a day-to-day basis, so we don't tend to focus too much on this sort of stuff. This is honestly pretty much within the range of normal market volatility that you would expect. I think the two key things that we are looking out for more is a sense of how the earnings season progresses, and the kind of sound bites that we get from the company. The anecdotal stuff is not very positive in terms of the data trends that we are seeing, but we'd like to hear from companies over the course of the quarter and see what kind of signals we can pick up for some kind of a recovery in the economy sometime during FY16.
But you make it sound.
Nothing that we've seen in the last month, 2 months, 3 months, 4 months suggests that volatility in the market has gone up dramatically. Typically normal levels of volatility that we are seeing in the market. So there's nothing from the volatility which tells us that we are dealing with an unusual, sort of marketplace at this point of time. In terms of dealing with market downsides, there's no simple way to deal with that. Beyond a point, if you are invested in the market, you can't divorce yourself from market downsides. It's part and parcel of being invested in the equity markets. But I think at this point of time, the way we look at it, you've got a challenge, which is that market valuations have moved up over the last 1 year. In fact, they've moved up quite significantly over the last 3.5 years. We're still in an environment where economic data is not really showing a significant, and therefore there is concern about the earnings growth, not just for the quarter gone by, but even how realistic are the earnings estimates for FY16, for example. So I think in that kind of a scenario, our thought process right now is more to sort of stay focused on bottom-up stock picking. We don't have visibility on when exactly economic growth is going to improve. We don't have visibility on when operating leverage benefits might start to flow through corporate profit and loss accounts. We do recognize the potential for that. We do recognize the potential for interest cost savings, but we don't know when all of that will actually start to become visible. So our process really at the point of time is more to sort of back bottom-up conviction on individual stocks, in the sense that we don't know when the earnings recovery will actually kick in, but we think some of these companies are perhaps best placed to get the benefit of that cyclical recovery whenever it were to happen. So that's really our thought process. And beyond a point, I think the only way to insulate your portfolio is to make sure you're invested in companies which bottom up are both structurally in a strong place, are financially sound, and not to get carried away with too much of theme-based investing, because that can prove to be quite harmful.
Where do you think those green shoots are going to be visible first?
Honestly speaking, right now we haven't seen too much of green shoots. If I go back about a year, in the middle part of 2014, was some indication that a lot of the data points were turning up, but after that we've not really seen any further acceleration at this point of time. If anything, sort of flatlined after that. So I think it's still sort of early days in terms of spotting where the green shoots are. Our sense is that if you really want to try green shoots, it may not come from some of the things that you tend to look for, which is things like credit growth and automobile sales. I think the more important thing to track would actually be the health of corporate cash flows, because really what India is facing today is a twofold challenge. Global growth is also weak, which is creating a downside pressure. And the second problem is that corporate balance sheets are overextended. Banks have their own set of financial problems, and the whole sort of capex build out is very, very slow. But the key to reviving capex is first putting the balance sheets back in good health, and the key to that is better cash flows from the existing businesses or significant M&A activity. And we have seen a significant level of pickup in M&A activity in a lot of the infrastructure related sectors and even in some of the other areas. I think that really holds the key, because that will really tell you when corporate India's balance sheet is starting to look healthy again, and that is in fact a precursor to seeing strong capital investment. So rather than look for the green shoots in the second phase, I think what's more important to track is the health of the cash flows. And we are still in the very early days of seeing those improvements.
Vetri, what is also important is that how should one protect their portfolios in this declining regime Stocks are off 15, 17, 20, even 25%. So, assuming that Indian economy will progress and that recovery is 2, 3, 4 quarters away, what does one do in the interim?
Well, we don't look at it from such a short-term basis, Nikun. So I don't have a system that I could give you to prevent you from being exposed to that kind of a risk. Most of our funds are run on a fully invested basis, and we look to stay invested, because we are looking at this more from a 5-year plus kind of perspective in terms of where one will be able to create value for equity market investors. And I think eventually it goes back to the basics of investing, which is all about picking the individual stocks which can handle both the bad times as well as be able to run even faster when the good times come around. And I think that's really the only way to protect yourself, and beyond a point you cannot wish away market downside. My 25 years in experience in the stock market tells me that there will be bad times and there will be good times. You've just got to learn to survive bad times, and the better quality stocks that you're invested in, it's more likely that you will be at the starting line. Gun is fired again, and you see a strong economic upturn play out all over again.
There is one group which I definitely want to discuss with you, Vetri, is the entire two-wheeler space. The two-wheeler sector was considered more like a great structural story, but that structural story is now coming under intense pressure. Hero MotoCorp, TVS, Bajaj Auto, these stocks are down 15-20%. Given what has happened to the rural demand, do you think two-wheeler as a story is over in the medium term?
There are two parts to it. I think one is two-wheelers will continue to be a growth industry in India, but we are seeing one or two trends over there which are important to recognize at this point of time. One is what you pointed to, which is weak sort of trends in rural income growth. The second is clearly there's a demand shift that's emerging for scooters, and therefore while scooters have been growing well, the traditional motorcycle market has actually sort of slowed down, and in fact recorded perhaps a slight decline last year. So I think these are two changes which are happening overall within that area. But we still think the two-wheeler market in India will continue to grow. It's not as exciting a growth story as four-wheelers. So on a comparative basis, we think four-wheelers are a bigger growth story in India over the next decade. But at the right level, some of these two-wheeler stocks will also be attractive. They're very high, strong ROC, ROE businesses, high-quality franchises, and something that we'd be willing to own at the right valuation.
Right, Vetri. Glad you could join us, and thank you for your take and thank you for your time. The Bank Nifty is bobbing up and down. Nifty is under pressure, but you could blame it on HCL Tech and Sun Pharma. By the way, HCL Tech has stopped falling, and Sun Pharma at least has stopped falling